What is an adjustable rate mortgage, or what is an ARM loan? Well, as we know, in the last year or so, rates have really gone up. Interest rates have gone up and still may go up. So many buyers are looking for alternatives to paying the high mortgage rates. That's when the ARM, adjustable rate mortgage, come in, where your rates are lower than your conventional loans. And also 75% of all the loans are fixed rates, but up to 25% of the loans are adjustable rate mortgage loans. And they are very good if you need to use them. They have their advantages and they have their disadvantages. So let's talk about what an ARM loan is and the pros and cons of an adjustable rate mortgage. Hi, I'm Mike Patel with First Team Real Estate, and if you like this channel and videos that I put out, please subscribe. I would really appreciate it. So an adjustable rate mortgage. So the question is, when do you use an adjustable rate mortgage, and why use an adjustable rate mortgage? ARMs usually are mortgage rates where the interest rate is not fixed. That's a disadvantage of the adjustable rate mortgage rate, but it's used when you are unable to get a high interest rate. So let's say you are buying a house and right now the rates, as an example, is 6.5% annual percentage rates. And for some reason, because you have car loans or other credit card loans or a student loan, you are not qualifying, just barely qualifying with a 6.5% rate, but you really want to buy a house or an income property, and your lender suggests to you that, hey, why don't you get a 5.5% or 5% adjustable rate mortgage loan where you will qualify temporarily. So that's an advantage, where if you use an adjustable rate mortgage, the rate is lower than a conventional mortgage usually, so you can qualify. The disadvantage is it is not fixed for 30 years. So that means that if you have, let's say, an ARM mortgage loan known as 3-1 or a 5-1 or a 5-6, what that means is your adjustable rate mortgage is 3 years fixed and changes every 1 year on a 3-1 loan. On a 5-1 loan, ARM loan, your mortgage rate is fixed for 5 years, then it'll change every once a year. On a 5-6, for example, your adjustable rate is fixed for 5 years, and that'll change every 6 months. And these rates, adjustable rate mortgage rates, are tied to different indexes. And one of the indexes, for example, is a prime rate or a CPI, which is the consumer price index. So as the CPI or the prime or whatever index your loan is tied to increases, your rates go up, and if it decreases, your rates go down. The advantage of a fixed rate mortgage is that your payments are fixed, they are predictable, and you have a stable payment for the next 30 years. The disadvantage of an adjustable rate mortgage is if you have a loan for 5-1, your rate will be fixed for 5 years, but then you don't know how high your rate may go up because it changes every year after that. It could go down, but in the long run, it could go up. The best thing to do is if your rates go too high, and at that time, let's say you went from 5% rate for the first 5 years and it jumped to 8%, which has happened many times, and it happens all the time, jumps to 8 or 9 or 10%, then your payment almost doubles, or more than 1.5 times your payments, depending on the rates. Then at that time, you can adjust or refi your loan to a fixed rate or a different kind of adjustable rate. But that, I'm not going to get into details. By the way, I'm not a lender, so if you have any specific questions, talk to a lender who's certified to do loans. I'm just giving you general information on what an ARM loan is, because as a realtor, a lot of the buyers come to me and they want to buy a house, but they can't qualify, and we suggest that there are conventional loans, fixed rate, and adjustable rate loans, so you have an option. So I don't want to talk too much details on it, but wanted to give you a basic idea of what an ARM is. So let's continue. The other advantage of using an ARM loan, adjustable rate mortgage loan, is let's say you already have a house and you are trying to buy an income property, or you have a house and you have income properties and you want to buy more income properties. Of course, it's always advantageous to buy a fixed rate mortgage because your rates are going to be the same. So if you buy, let's say, a rental home and you buy a fixed rate mortgage at 5% and your payment's $3,000 a month. So for the next 30 years, your payment is going to be $3,000 a month regardless of the changes in the rates on the market, because your rate is fixed. But the option to use, or when would you use an ARM in this situation? Let's say I already have one property, my house, and I already have another rental property, and I want to buy another one because I have some down payment. But because I have 2 mortgage payments, I have a credit card payments, I have a car payment, I'm not able to qualify for a fixed rate. Let's say it's 6.5 in today's market. So I could opt to go on a 3-1 or a 5-1 or a 10-1, where the rate could be 4% or 5% for the first 5 years. And I may consider, you know what? let me get this house, at least I can qualify and buy it because I have the down payment, I have a good job, I have good income. But in 5 years, if I wait, I may not be able to buy it. So if I buy the house now or the rental property now, and as long as I know that I can refinance it before the 5 years where the rates probably gonna go up, so then I have the good option. So adjustable rates are good for short term, not for long term. If you want to buy something for long term, we recommend that you buy on the basis of a fixed rate mortgage. For the next 30 years, your payment is fixed. But if you can't qualify or if circumstances are that you have to get a fixed adjustable rate mortgage, which is fixed for 5 years or 3 years or 10 years, then opt for that, knowing that sooner or later you're going to have to refinance or get another loan. The other thing you may want to check with your lender is that you may not be able to refinance right away. Some of the lenders have prepayment penalties, so they may say, hey, you cannot refinance for the first year, second year, but there's all minor details that you should know. That's why I recommend you talk to a lender. But if you're in a situation, then this is a good time to get an adjustable rate mortgage loan should you need to. By the way, I also have a video I did, Pay No More Mortgage. Please look at it. It gives you an idea that if you already own a house, how you can pay it off faster, maybe in 4 years faster, 5 years faster, or even 10 years faster than just paying regular payments. So check out the video. I will also put it in the description. Thanks for watching.